welcome. It's Drew Blazik, Logos and Markets. In this third and final video on WACC, we're going to find out what is the capital optimization structure of the business to minimize WACC and to maximize the stock valuation of the company. The first video, we found out how to calculate WACC based on the actual financial model. And then we found the WACC. And then what we did was in the second video, we looked at, well, what's the valuation of the business? What's the equity value? What's the enterprise value? And then we found a sensitivity analysis based on, well, what if you change WACC and you see the impact it has on the valuation of the company? And the third one, we're going to see, well, how can we change WACC and the valuation of the company by changing the capital structure based on, do we want more debt or less debt? So let's get right into it. I'm going to show you what I did here, and I'm going to go through this kind of quick because I know the other videos were about 23 minutes long. I want to show this. So this is the first part we did, sensitivity analysis based on 3 different cases. And then here, the values I wanted to bring in was the capital structure, which is how large the business is, the risk-free rate assumption or market assumption, market risk premium, tax rate, corporate tax rate, what's our EBIT for the first projected year, shares outstanding, the current value shares outstanding, a levered beta, which is the beta that represents if you have zero debt, if you have no debt at all, and as you increase debt, it becomes more risky. Our beta becomes more risk, which means we can make more money and we can lose more money. All right, so first thing we want to do is we want to find out the amount borrowed. We're going to plug that in. And we're just going to go up here and do the 177. That's all our debt. Just a reminder, we have 3 forms of debt. We have revolver, fixed, and variable debt. And then we want to know, what do we want to change our debt to capital structure as? So if I want increments, this all it means is increments. I want increments of 5%. That means I want a capital structure of, and I got to bring this in. This is, well, what is our debt to capital structure? So that's 177 million divided by 571. That's 31%. So this is a increment of 5. So do I want to have a debt to capital ratio of 26, 21 and go lower? Or do I want 36, 41 and go higher? And we want to see the impact it has on our WACC. All right, next we want to solve is, well, what's the equity to capital ratio? So all I'm going to do is I'm going to find out the equity up here. And we have common stock. And I'm going to divide it by our total invested capital. 63%. In the current, so if we decrease our debt to capital ratio and we increase it, you kind of want to think about, well, how do we find out what percentage of equity we have? So what we're going to do is we're going to take 100% and I'm going to subtract out the percentage of debt. And then I'm going to subtract out, I'm going to go up here, the percentage of preferred stock. And I'm going to hit function F4 to freeze the preferred stock. So if I hit 1 minus that, the remainder must be equity. As we decline the debt, we increase the equity. So I'm going to hit Control C, copy it. I'm going to go down. And then I'm going to hit Alt-ESF, special formatting, because I don't want to ruin the formatting what I created here. And that just plugs in the formula. Okay, since we got the debt to capital ratio, and then I got the percentage of equity ratio, I need the debt to equity ratio for the fact to find out what is our levered beta. I know our unlevered beta is, which is 1. I want to know, as we increase debt through the Hamada equation, what happens to our beta? Well, it's going to go up as we increase debt, but we want to know how much, which causes the return on equity to get more expensive. So since we got debt and equity, all I'm going to do is take the percentage of debt and divide it by the percentage of equity. I'm going to hit Control C. I'm just going to highlight the entire thing, hit Alt-ESF. And now we got our debt to equity ratio. Next we want to know is, well, what is our levered beta? So this is the Hamada equation. So if you want to look it up, I don't have a slide for us to look at. And don't feel bad if you don't know it, because I always have to kind of double check. It's not something you're going to memorize all the time. But what we're going to do is we want to find out what our levered beta is based on that debt to equity ratio. So I'm going to go equals. The first thing you want to know is the unlevered beta. We need to freeze that because we're going to multiply that by some numbers of all these different debt to equity ratios. So I'm going to hit function F4. And then what I'm going to do is I'm going to multiply it times, I'm going to hit a bracket. And we want to hit 1 plus, hit another bracket. And then I'm going to hit 1 minus, and we want that tax ratio, that tax rate. So I'm going to select that. Now you could hit that in my model, or you could just say tax rate. But you need to hit function F4 if you select the cell. If you spell it out, it's already an absolute value. So I'm going to close it up. And then I want to multiply that times the debt to equity ratio based on that debt that we have, the debt to capital ratio. So what I'm going to do is, as you can see, the equation kind of takes up the cell I want. So I'm going to select the cell above it and just hit down. And you do not want to hit function F4 because I want to have all different debt to equity ratios. And then I'm going to close that up and hit enter. Hit Control C, highlight it, hit Alt ESF, and now we have our betas. Now we can do the kappa model to find out what is our cost of equity based on as we increase the debt or decrease the debt. So I'm going to hit equals, and what we want to know is the risk-free rate plus the beta we just selected. I'm going to do all betas, and then I'm going to multiply that times the market premium. And then that's going to give us our cost of equity. Again, I'm going to highlight it, Alt ESF. And now you can see as you issue more debt, the costs, investors require a higher return on that stock because you become more risky. Risk isn't bad. Risk means you have a greater chance of making money, but you also have a chance of losing money. For me to buy it, I must earn more money. Okay, I'm going to bring in the current debt level, the next part, because we're going to calculate the WACC. And that was, our cost of debt was 7.5. That's before taxes. I hard-coded these in, no real reason. All I showed was with more debt, you're going to be more expensive, you're more risky. That means a bank will charge you a higher interest rate. So I just showed less debt, you're less risky. You should have a lower interest rate. Next, we want to calculate what's the after-tax cost of debt. So I'm going to multiply that times 1 minus the tax rate. Oh, I didn't do the minus. All right, I'm going to hit Control C, and I'm going to highlight all those and hit Alt ESF. And now what we could do is we calculate our WACC. So again, what is WACC? It's a weighted average cost of capital. So what I'm going to do is I'm going to do debt first. I'm going to take the after-tax cost of debt, and I'm going to multiply it times the amount we have borrowed. That would be, the weight. We want the debt, the percent of debt. So we got the weight of debt, 31%, times the cost of debt. And the cost will change based on the debt to capital ratio. Then I'm going to say plus. Now we'll do the cost of equity. So we have equity there. That's the cost of equity. And we're going to multiply that times the weight of equity, which is right here. And then I have to hit, I'm not going to hit dollar signs, right? Because I want those to move based on that. But now I have to include our fixed weights and cost of preferred stock. So we have the weight of preferred stock. Now I'm going to hit function F4, and then I'm going to multiply that times the cost of preferred stock. Function F4, hit enter. Okay, so that color is going to pop up. It's going to show our lowest WACC. And as you can see, based on our capital structure, we could lower our WACC by a 21, so in that range. Now, if I was doing a true analysis, I'd probably do 0.5% changes to really narrow it down. What's the exact debt to capital ratio? But it's close to 21%. Closer to 21 than 16. If you really want to narrow it, we could go to 3% increments. See, it's 19. Looks like it's closer to 19 than it is 22. So it looks like it's probably around 20%, right around there. But again, I would do, this is for teaching purposes, I would do a larger model to show that. Okay, so we can see that that's how you minimize WACC. Now let's look at the valuation of the company. So we want to find out the enterprise value and the equity value. All right, first I want to find out what is our current level of debt. I'm going to plug that in. So based on our debt to capital ratio, if we decline it by 5% to 26 to 31 to 16, this is how much debt is declining by that corresponds to that debt to capital ratio. If we want to increase the debt to capital ratio, this is how much debt we have to increase it by. So what we want to do is, and just follow along. There's no real reason if it's going to be positive or negative for now. What I want to do is I want to say, well, that's $29 million. I'm going to divide it by 40.9, the current market price of our company. I want to find out how much does that convert to shares outstanding. And what you have to do is you have to multiply that times 1,000 to convert it into the correct shares outstanding, because this is really millions. So if we decline it by $29 million, that means that's going to be 698 shares. That's all it means. So let's copy that. And I'm going to highlight these cells, hit Alt ESF. Oh, made an error. And what that was, I need to hit Function F4 to the stock price. Sometimes I forget. That's what I love about this model. It'll tell you made a mistake instantly. Of course, you see the errors, right away, but the colors always help me out. So depending on our debt to capital ratio, our capital structure that we are desiring, this is how much shares outstanding that it converts to. So why is that important? Because pretend you own a business and you want to have more debt. You have a business partner. So how would you, what would you do? I want more debt than equity. So what I would do is I want to buy off my business partner. I would take a $2 million loan and I would take that $2 million. I have a lot more debt and I would buy off my business partner. Now I'm the sole owner. So that's the same concept as a corporation, is that if they want more debt, they issue a loan and they buy back the shares. And the other way around, if they want more equity, they would issue new shares outstanding, raise $2 million, and they would pay back the debt. They would buy back they would pay it back, the debt. So now you have less debt, more equity. So that's what we got to figure out here. Now, based on if we want less debt or more debt, we want to find out what is our shares outstanding. So in this box, I'm just going to type in shares outstanding. We currently have 14 million. And what we're going to do, very simple, I'm going to take the current shares outstanding and I'm going to hit Function F4 and I'm going to subtract it by this number. So since it's a negative, if I'm taking less debt, I'm subtracting a negative. That means I'm adding in shares outstanding. So that's our shares outstanding are increasing if we lower our debt, because I have to issue more shares outstanding to pay off the debt. So let's copy that cell and we can see how shares outstanding are going to go up. And then the same thing here is if I want to increase my debt, I'm going to take that loan and I'm going to buy back the shares outstanding. That's going to do with the money raised. And that's going to lower my shares outstanding. So what we're going to do here is this minus a positive, which actually subtract it, right? So now we have a good idea what our shares outstanding are based on our debt level. And now we want to find out, well, what is our earning? Now, we're going to find out our earnings per share. Our earnings per share isn't going to correspond to the minimum WACC. That doesn't mean the same thing. But the valuation should be maximized with the minimum WACC. But earnings per share are a little different. So what we have to do to find the earnings per share, we have to find our net income. So we're going to do a different method. Now we do have the income statement. We could do it that way. But what I'm going to show you another way, based off the numbers above. So I'm going to go equals. I'm going to do two brackets and kind of follow along as I'm doing it. I'm going to take the EBIT, our earnings before interest and taxes. That's the last recorded. I'm sorry. That's the last the first projected year of next year. So what we want to do on the income statement, earnings before interest, I have to subtract out the interest. So at this level of debt, what I'm going to do is, well, here's the amount borrowed, right? And I want to find out all levels of amount borrowed. I want to find out what's the interest payment. And I'm going to multiply that times the costs of debt. You want the before tax costs of debt, not the after. Okay. So I'm going to multiply it times that rate. All right. So I'm going to close that up. Close the bracket. And now I want to take out the taxes. So I'm going to do another bracket. I'm going to do 1 minus the tax rate. I'm going to close that up. And then next what we want to do is we want to divide it. So that's our net income. I took out the interest payment of all levels. And then I took out the taxes. So next what we want to do is we want to divide it by, so I need a double bracket because I want that entire thing that we have there. I want to divide it by the shares outstanding. So I'm going to select this cell and I'm going to go 1 over. I want that specific shares outstanding that has to do with that debt to capital ratio. And it goes up or down. So you don't want to do dollar signs. And then I want to multiply that times 1,000 because we need to convert it into the actual dollar. Now let's copy that. Highlight it. Alt ESF. Oh, I love when I do that. What I do wrong, I always do that. I forgot about the EBIT. We have to freeze the EBIT. That's the first value. I believe that's it. And now if I copy the whole thing, hit Function F4, I'm sorry, Alt ESF, there we go. See, the earnings per share did not maximize, right? It's at this debt level. It's not equal with where we minimize the WACC, just to show that. Okay, now what we want to do is we want to find out what is our present value of our cash flows. So we want to find out the terminal value, the cash flow value, to find out the enterprise value and the equity value to get the stock price. All right, so what we want to do here is I'm going to go into that first cell here. I'm going to find the present value. So I'm going to do the net present value function. Just make it quick. First thing we want to do is find the interest rate, the WACC. So this WACC here, I want to find the WACC that corresponds to the different levels of the debt to capital ratio because it changes. So I got to know that I'm going to discount them all at a different WACC, and I'm going to hit comma, and then I'm going to go all the way up here. And remember, we did this in the first video to find the valuation. Here's the unlevered free cash flow for the next 5 years. So I'm going to highlight these values, right? Because we're finding what we did before, we found only those values of that WACC. Now I want to find these. So I need to freeze those. I'm going to highlight that, hit Function F4. So I want all different WACCs on those. And all I'm going to do is close it up. And I did something wrong. Let me see what I did here. Oh, hold on. Sometimes it doesn't work. You know what? I did this when I created the model in the first place. If you look what I did, and this is a good learning lesson, is when I highlighted those values, right? I highlighted it, and unless you see what you did, it gets kind of frustrating. To hit function F4, unless you select out of the highlight, as soon as you hit enter, it's going to delete it. So that's good. Okay. So now we got the present value of cash flows. Now all I have to do is I got my dollar sign. We got the WACC, which will move the dollar signs on the cash flows. That's perfect. I'm going to highlight it. It's going to show the present value of all those. Perfect. All right, next what we want to do is we want to find out what is the present value of the terminal value. We found the present value of the projected cash flows, but we're going to say the company's going to go forever at a constant growth of 2.5%. So let's find out what's the present value of the terminal value that we have. And all right, so the first thing we want to do is I'm going to go equals, and I'm going to hit a bracket, and we want to know to find the terminal value in the 5th year. So we did this in the first time. I have to know the cash flow of the next year. So I'm going to take the 5th year because we don't have the 6th year because this is for year 5. And I'm going to multiply that times 1 plus the growth rate of 2.5. So that's going to be our 5th year. I'm going to function F4. I'm going to close that up. 2 brackets to close it up. So that's going to be the 6th year. I'm going to divide it by. Now I'm going to do the the WACC. All the different levels of WACC minus the growth rate. That's the Gordon growth model. There we go. And I need to freeze that. Make sure you always freeze the correct cells. So this is going to be the perpetuity, right? Everything looks pretty good there. You know what? I'm kind of messed up there. I don't know why I have the J21. I think that's the issue there. Okay, there. And then, so that's going to be the value of the company in the 5th year, right? 5 years. However, we have to discount that to the present. So I have to put a bracket, open bracket, a closed bracket, and I'm going to divide the valuation in the 5th year. That's all future cash flows starting in year 5. And then I'm going to discount that to 1 plus the WACC that corresponds to that debt level. Close it up to the power of it happens in the 5th year. There's the present value in the 5th year. I'm going to hit Control C. We'll find out the present value of all different WACCs. I love when that happens because you can see where you made a mistake. And where did I make that mistake was I needed to freeze that free cash flow. So I'm going to hit that, hit Control C, highlight it again, make sure that free cash flow does not change. There's the different values of the terminal value into the time 0, which is today, of all different WACCs. And then now we can find out what is our enterprise value, which is the present value of the projected years plus the present value of the terminal value. I'm going to hit Alt ESF. Now I want to find out what is our net debt based off of our debt to capital ratio. So I'm going to go equals. And where's our debt at? This is our the amount borrowed, all the different levels. I want that to move. I'm going to say minus. I have to go to the financial assignment or model, and I have to find cash for the next year. And I'm going to hit function F4 to freeze it. That's going to be our net debt. Control C. Highlight it out. There's our net debt. You can see we'll have more cash there. And then to find our equity value, we're almost getting there. Our equity value is going to be our enterprise value minus our net debt. In other words, if we sold a company, how much of that money is going to the equity holders? So we have to pay off the debt. How much cash do we have? Pay off the debt, and then we have the remaining balance, and then the equity holders. And then I'm hit Control C, highlight it, hit Alt ESF again. There's the equity value of the company. You can see that it goes down and up. Well, the reason why it looks so low down here is because we don't have as many shares outstanding, right? We're becoming more debt. We bought back our shares, more of a debt company. So what we want to do is we want to find out what is our maximum price. It should correspond with the WACC. So it should be right there, 2 up. So what we're going to do is we're going to say, we're going to equals. It'll be the equity value. Remember, that's in millions. I'm going to divide it by, you have to divide it by the shares outstanding. There's different levels. We want to know the average price per share. And then I'm going to multiply that times 1,000, because that's in millions. And then we can see, so before it's yellow because that's the only one, it's going to do the top value. Oh, there we go. So our WACC corresponds, so we maximize our stock price roughly around a capital structure of 21% debt. It minimizes WACC and it maximizes stock price, and it shows how those are connected. And what it does show, that earnings per share doesn't always match up with that. To maximize earnings per share is a different debt to equity ratio. So that's kind of an important thing to see, but this should always match up, because if you minimize WACC, you would maximize your equity value in the company. Okay, there you go. This video went a little longer than expected. This is the third part of this series, the last final part. Again, the first one we found WACC. The second part was the valuation of the company. And the third part was to find out the capital structure that maximizes stock price and minimizes our WACC. I want to appreciate. Thanks for watching it. God bless, and lost to be Christy.